What is going on, Navigation Nation, and welcome back to another video. By far and away, the most common question that I get from members of the community is PokéNav, what should I invest in? And undoubtedly, every single time my answer is, it depends. And this is what I mean by that. So as you guys know, I am a former financial advisor, and any time that I sat down to construct a portfolio for a particular client, we had to take into consideration a multitude of different factors in order to make a good recommendation for the investments that would be included in their portfolio. And one of the most integral aspects of constructing a portfolio and giving sound advice is taking into consideration a particular client's risk tolerance. And what I mean by that is the risk versus reward scenario. And in this case, the reward is the added gains in a portfolio, and the risk is how much is a client willing to potentially lose in order to get those higher gains. Now, this is not just applicable to the financial world, but also to the Pokemon card market as well, and one that I don't hear discussed often enough. So today I am going to go through a full discussion on risk versus reward in the Pokemon cards market. We're going to go through that spectrum of risk tolerance so that you can get a better idea of exactly what type of investor that you are. And then I'm going to also give examples of each of these risk tolerance levels for different Pokemon card investments so that you can construct your portfolio, your collection, your investments around how much risk you are comfortable in taking. But before we jump into that, guys, go ahead and do me a favor. Give me that double slap attack. One for that like button, one for that subscribe button. And if you want to be notified each and every time a new video drops, go ahead and thunder punch that notification bell so that you don't miss a single video. And with that being said, guys, let's go ahead and jump right into it. So as you can see here, first and foremost, we have what is known as a risk tolerance scale. So on the right-hand side, you have a high-risk investment or a high-risk investing style. On the left-hand side, you have low risk. Starting off with a conservative type of investing style. Really, with this one, the primary goal is to preserve capital, even if it means missing out on potential returns. So in the financial markets, a conservative type of investor would be somebody that is at or near retirement. Their goal is really just to preserve what they have built up to that point. Moving up the scale, you have then a moderately conservative investor. Now, the primary goal here is to preserve principal, very similar to conservative, but you're willing to accept a small degree of risk for added gains in your portfolio. So you're okay with taking on a little additional risk, but not too much that it endangers your principal amount. In the middle there, we have a moderate investor, and really your primary goal is to reduce risks and enhance returns equally. So you're really kind of getting that fine balance, at least in the financial world, of stocks and bonds, and you'll see how this also relates to Pokemon card investing as well. Beyond that, you have moderately aggressive. Primary goal here is long-term returns. And here you're willing to accept a significant risk in order to garner those higher returns in your portfolio. You're okay if there's a big, if you have a loss in your overall portfolio or among your investments because maybe you've got other assets elsewhere or you've got a longer time horizon, which we'll get to that here shortly. And then finally, you have an aggressive investing style, and the primary goal here is maximizing returns. That is the main goal here. You want to try to get as much return on your investment as you possibly can, and again, you may endure extensive volatility and significant losses, but you are okay with that. So that there, guys, is the risk tolerance scale. This is something that we use very often in the financial world to address how much risk a particular client is willing to take, and it's also applicable to Pokemon card investing because you'll want to know how much risk you're willing to take, and then you will be able to better decide which type of investments you want to actually garner garner and have as part of your collection or your overall investments. Now, the other thing that I mentioned there is also time horizon. Now, typically in the financial world, when we talk about time horizon, it's how long you expect before you want to sell those investments or actually start garnering some type of profit off of those investments. Typically in the financials, the longer time horizon that you have, the more aggressive that you can be. It's almost the exact opposite in Pokemon card investing, where the longer time horizon that you have, generally the more conservative that you are, because you're going to need a longer time horizon for those particular assets to appreciate. And then again, the shorter time horizon that you have, maybe a year or less, you're going to be more aggressive because you want to flip those products more quickly and take advantage of short-term profits. So kind of an inverse relationship there when we're looking at the Pokemon card market. So now let's go ahead and move on, and I'm going to give you guys some examples on exactly what products you should be looking at, in my opinion, based upon your particular risk tolerance level. And the first one that we'll start off here is conservative. And again, a conservative investing style is where you're looking to preserve capital more than anything. And in my opinion, the best example of a conservative type of investing style in Pokemon cards is vintage booster packs. I refer to these as the investment grade bonds of Pokemon. So if you guys are familiar with the financial world, you have different levels of bonds out there. At the very highest, you have what are known as treasury bonds. And the reason that they're at the top is they're backed by the U.S. government. So they're backed by the full faith and credit of the U.S. government. So you have a very, very small likelihood that these bonds are actually going to default. So these are the investment grade bonds of Pokemon, in my opinion. And the reason being is you see very little price movement in either direction with vintage booster packs. You don't see them go up too much. You don't see them go down too much in a short-term time frame. Usually they are pretty stable, but at the same time, you're not really going to experience a lot of return on these particular investments, at least in the short term. Again, with Pokemon, the time horizon here for more conservative, you're looking for a longer time horizon, probably like a 10 plus year time horizon. The other nice thing about vintage booster packs is that, even if the price of a booster box that they came from, even if that's falling in price, generally the booster packs will maintain a steady value. They don't drop nearly as much as the overall booster boxes. So they are, they are a more conservative investment in that regard as well. So here we have, to start off, guys, this is more of the conservative type of investor. If your goal is to preserve capital more than anything else, and you've got a longer term time horizon, then I would say vintage booster packs are probably a good area to look at. Moving on, we now have moderately conservative. Again, our goal here is that we're willing to take a small degree of risk for the added gains. To me, the best example is elite trainer boxes. I've referred to these as the bond funds of Pokemon. So if you guys are familiar with mutual funds, it's basically a basket of security. So it could be stocks, it could be bonds, or it could be a combination of both. In this case, with the elite trainer boxes, I think of these as the bond fund. So basically a basket of bonds here. Now, you guys have probably heard me in the past refer to booster boxes as the mutual funds. Now, those would be kind of a combination of both stocks and bonds. The reason I consider elite trainer boxes bond funds is that you don't see the volatility with ETBs like you do with booster boxes. And the big reason for this is that they have a much less chance of being reprinted versus booster boxes. And the reason why is that, logistically, it's really difficult to reprint ETBs. The cards are printed in one geographic location, the dice and all of the other products on the inside are printed in another, usually from a foreign country, very often China. So it's logistically just really tough to reprint these products. And then on top of that, just to try to reprint something that also has other products on the inside, whether they were produced in another country or not, to reprint those dice and everything like that, just more difficult than actually printing another booster box. So the nice thing about these, and the reason that they are lower on the risk tolerance scale than booster boxes, is because there's a lot less likelihood that you'll see these reprinted. It is, however, still possible, and one of the examples would be Hidden Fates, of course. Now, the nice thing about even when these products may be reprinted, you don't see a whole lot of fluctuation in price, maybe in the short term, but over the course of another year or even less than that, 6 months, it really gains momentum once again. So again, here with the ETBs, if you're more or less looking for a small degree of risk, for those added gains, but you're still, your primary objective is to preserve your principal, ETBs are a good option, because very often if you're purchasing these at MSRP or especially at wholesale price, you've really created a floor for those prices to fall. There's really a very slim chance that they're going to fall below MSRP or below wholesale price especially. We've moved on now to a moderate type of investor. Really, the objective here is we're reducing risk and enhancing return equally. That is the main objective. So you're okay with taking additional risk, or you're okay with reducing risk while at the same time enhancing your return. So it's really a balanced approach. So some of the best examples that I can think of here would be modern and ultra modern booster boxes. And again, I've talked about these, booster boxes in general as kind of the mutual funds of Pokemon. If you think about it, the booster packs, as I said, are like the bonds, graded cards are like the stocks, and all of that is really inside a booster box. And you also have the option of keeping it sealed. So that's why I think of booster boxes as the mutual funds of Pokemon card investments. Now, with these, you're also going to be able to take advantage of short-term price movements. As many of you have seen with a lot of modern and ultra-modern sets, after its release, they do typically garner a pretty high value after its initial release. You can look at a set like Vivid Voltage, now getting close to $250, which its original price was around $100 MSRP. So you can take advantage of some of those short-term price movements. And again, you are essentially creating a price floor if you're purchasing these at MSRP or especially at wholesale. You're not really going to see these fall below those particular price points. Now, we've seen something like Steam Siege, which has fallen to even as low as $75 a booster box, but now has climbed back up once again after a few years to over $200. So again, there's pros and cons to each of these. There's risks and rewards to be garnered with booster boxes. That's why it kind of falls in that moderate range. The next one that I would consider are vintage theme decks. So with these, we already know what cards are featured on the inside of theme decks. So there's not a lot of guessing going on. There's not a lot of speculation. We know what holos are in there. We know what commons and uncommons, how many energies, all of these different factors. So with the same thing here, you don't really see a whole lot of price fluctuation in these type of products, especially when you compare that to something like vintage booster boxes, which can vary pretty wildly, and that's not even to mention vintage graded cards. So, the same thing here. Price movements much less volatile than other sealed vintage products. With a lot of these theme decks, their growth has been pretty slow, but it's also been fairly sustainable as well. Now, there's still risk in there in that, in knowing what is inside a theme deck. Typically, the cards on the inside aren't as valued as if you were to just get a booster box where you don't know what's on the inside. There is some speculation information there. There is some unknown. So you're not going to see, in my opinion, the same type of returns as with some of these other sealed vintage products, but at the same time, you're not taking on as much risk. Okay, now we've made our way up into more of the aggressive type of investing style. And this is where I find a lot of new people entering the hobby and really putting all of their eggs in one basket in being either moderately aggressive or aggressive. So again, we're looking to have a balanced approach here, at least for most people. Now, with moderately aggressive, the goal here is long-term returns. You want to be able to garner a steady or even a high return over the course of time or year over year. A good example here, in my opinion, is first edition Wizards of the Coast graded cards. I've considered these the blue chip stocks of Pokemon. One reason is because they have established data points. So for those of you that may not know, a blue chip stock would be, something like an Amazon, a Microsoft, well-established companies. These are companies that pay typically consistent dividends, and they're liquid. There's a lot of people that want these particular securities out on the open market. Same thing here. These are the type of cards that everybody wants, and so they are highly liquid. And again, with these established data points, we know what the pop reports are for these cards. Because they're scarce, because they're rare, we have a very well-established population report, and we can derive a strong value for these cards in the present moment on current market value, as well as moving forward into the future and projecting or predicting what those will be in the future. They also have a strong sales history. So, as I said, they're liquid. We know what the sales history has been. We've got sites like Pokemon Price where we can see all of these facts and all of these figures, and that's what really sets them up. However, they are in this aggressive category because they can also vary wildly in price. They are going to be more volatile than other sealed products or many of the products that were just mentioned in the three risk tolerance categories. Beyond that, you also have trophy cards, in my opinion. So again, we can be very confident in their overall supply. Something like a Kangaskhan card, we can be very confident in how many of these cards are actually out there because they were given out to winners. They were given out to the winners of tournaments, so we can derive exactly what the supply is versus other products where we are kind of in the dark. And again, these are also liquid due to their scarcity. Because they are so scarce, there's people out there, especially high-end collectors and investors, that are ready and willing to pick up these particular products. But again, guys, these come at really high price points. And if you're over leveraging yourself, this can really turn into an ugly situation for you because these could, fall in price. Even a 5% dip in these particular products can mean thousands and thousands of dollars. So that's why you see them here in this moderately aggressive category. And then the last one here is aggressive. And again, this is where I see a lot of people falling in line, predominantly in this aggressive type of category, especially new people that are coming into the hobby without a lot of knowledge or experience. Now, with the aggressive, again, our main goal here is to maximize returns. People in this category are okay with taking on significant risk in their overall investments because, again, maybe they've got investments elsewhere. They've got a diversified asset class amongst their entire portfolio. And this is speaking more in the financial realm or in the financial markets. But with Pokemon, the more aggressive type of investments, in my opinion, are modern and ultra modern graded cards. Now, I compare these to speculative stocks. So when you look at a speculative stock, they have some makings that investors think that have a lot of potential, but at the same time there's a lot of uncertainty there as well, as far as maybe how the company will perform, if it's a new company, all of these varying factors. Here, Some of the examples would be something like the Charizards from Champion's Path, Darkness Ablaze, etc. What we've seen here is that these cards usually shoot up in price after their initial release, especially those that are the first to hit the market. But then they take a hit by almost half most of the time back down to kind of their equilibrium point, and then it's a slow and steady growth over time, or sometimes perhaps not at all. And that would be examples of like the full art cards or hyper rare cards. Again, a lot of the time, these go up in value very quickly after a set's initial release, and especially the first cards to hit, things like PSA or Beckett pop reports, they do garner that premium in the beginning. But after that, once many of them have come to market, they typically take a hit, and some of them never really recover, especially if a lot of people are having these graded. The pop reports just continue to increase, and then that card is not so scarce, it's not so rare anymore, and the supply outweighs the demand. So really the goal here, in my opinion, for many of these cards is to be the first to market. That's generally where you're going to see the biggest return on these particular cards, is being the first to market, or typically getting your cards graded and then getting them back onto the market as quickly as possible. So a time horizon here for an aggressive type of investor would probably be a year or less versus many of the others that are going to be well beyond 1 year. On top of that, you also have vintage booster boxes. Now, I consider these the small cap mutual funds. So a small cap mutual fund is going to be composed of small cap companies. These could be startups, companies just starting off that are just trying to gain traction. And although there may be a lot of potential, or investors see a lot of potential with these startup companies, there's uncertainty there as to how they will actually do and if they will in fact prosper. So same thing here, as I said, booster boxes are kind of mutual funds, and I consider the same kind of risk taking with booster boxes is the same type of risk taking you would take with like a small cap mutual fund. So the returns on these can be significant in a very short amount of time. We have seen that. We've seen the first edition base set booster boxes, even unlimited. All of these do have the potential to increase in value very, very rapidly. But at the same time, something that we want to take into consideration is that the losses can also be quite dramatic with these booster boxes as well. An example would be the base set unlimited booster box. Back in around September of 2020, this shot up from $8,000 to around $35,000. Now, if you were purchasing it at that $35,000 price point, you probably thought it was going to then, double or triple once again. Well, it actually fell down to now around $20,000. So if you were in early and purchased at $8,000 and then sold at $35,000, you were sitting really well. But for many people that come into the game late and purchased at that $35,000 price point, they are now looking at a deficit in their investment of about $15,000. So those are all things to take into consideration when you're looking at this type of investing style. And again, this is where I see so many people fall into, is either moderately aggressive or aggressive. And in actuality, in my opinion, it should be balanced. And that really leads me to my conclusions here. Overall, the best approach is to diversify your collection to take advantage of every market condition. So to me, that's having a mixture of everything. If it's within your power, if it's within your financial means, to have a diverse portfolio of all of these different investments, no matter what the market's doing, you can kind of rely on one area, one type of product that may supersede the other in those current market conditions. We do the same thing in the financial world. We construct portfolios that have a mix of different types of assets. So no matter what the market is doing, we can fall back on, or we can reallocate. So that's the other thing that you want to do here, is you want to take the time to review your investments and reallocate if needed. And what reallocation means is just adjusting how much of one investment you have versus another. So, if the market is really hot and, prices are soaring, maybe you're reallocating to more of an aggressive type of investing style. If the market is doing poorly, or you plan on just waiting out the market, being more conservative and waiting that 10 plus year time horizon, perhaps being more conservative, going more towards the booster packs, the ETBs, those type of investments would be better suited for you. But you need to take the time to review your investments and then reallocate if you need to. The other thing is to remember to factor in your time horizon. How many years are you really looking to basically take advantage or profit off of your investments? If it's 1 year or less, then you're probably going to be really aggressive. If it's 10 plus years, then you're going to be very conservative, or you can be more conservative because you've got a longer time frame for those products to appreciate. And then last here, guys, just do not over leverage yourself. So that basically means don't go into debt trying to garner, higher end products or overly aggressive type of products. Do this within your means, within your financial means, and ultimately you will have much more success. And last but not least here, above all else, enjoy the journey. Enjoy the journey of investing and collecting into Pokemon. And if you take some of these different tips and strategies, like the one discussed here today in assessing your risk tolerance and just understanding where you lie on that spectrum, then overall, in my opinion, you will be much more successful once things are all said and done. So guys, that is going to do it for today. I hope you enjoyed this discussion on risk tolerance and how it relates to the Pokemon card market. And I hope that you guys will take this and use this information to make yourselves better collectors and investors. And I also hope you enjoyed the type of video that I put out, the style of video. If you guys like more of these lecture type of videos, then let me know down in the comments below. And I'll continue to do this. I've also considered maybe doing these type of videos in a live fashion where I'll do about a 15-minute lecture and then about 15 minutes of discussion and Q&A. So let me know if you guys are interested in that as well. But other than that, guys, I will see you all next time. My name is PokéNav. I'm here to help you navigate the world of Pokemon one video at a time, and I will see you all in the next video.